Welcome to Money. I'm John Collet, Personal Finance Editor at the Sydney Morning Herald and The Age, and I'm joined by Clancy Yeates, Business Reporter. Now, everyone knows that DIY super funds are growing rapidly, fastest growing sector of superannuation. Clancy's been having a look at how they invest and what sort of investment returns they're getting when compared to large super funds. Clancy, what have you found?
Well, John, they tend to be very different type of investors, DIY funds on the whole. In the jargon, they're much less diversified, so they concentrate on a few asset classes more than others. Those are cash, big exposure to cash, around about 30%. Property is another big one, and the biggest is Australian shares, where they also have close to a third of their money tied up, on average.
Yes, so for me,
definitely
investments for most people, right?
Yeah, sticking to the assets we know, bricks and mortar, cash, Australian shares, all quite easy. The big areas where they have very little exposure compared to the large funds are fixed interest, so that's bonds. There's next to nothing there.
And that is interesting, isn't it? I mean, obviously the large funds take advice from investment professionals, and they're saying, listen, we've got to be pretty well diversified here. It's what we always hear about investing. Generally, the better diversified, the better. But here we have DIY fund trustees who seem to be just going for kind of three asset classes rather than spreading their money a bit more widely. But what's been the result of that difference in diversification?
Well, surprisingly, it's a strategy that's worked pretty well. Now, I have to caution here that the figures are a little bit, they're not quite as up to date for the self-managed funds as for others, but the latest numbers from the tax office and one of the consultants, Rice Warner, they show that in 7 of the last 8 years, DIY funds have got better returns after fees.
Okay, but that includes the GFC years, obviously.
Does include the
GFC. I suppose if you're overweight to cash, when equity markets are heading south, and those GFC numbers wash right through, don't they, when you look at average annual returns. So it's certainly going to be a big help, just being overweight cash, I suppose.
Yeah, it paid off during the GFC, that heavy exposure to cash. And then since then, it hasn't been quite as compelling. Not owning the international shares, for instance, you'd miss out on quite a good year in the last financial year. International shares did better than the local stuff. But on the whole, the strategy's worked out okay so far.
Yeah. So that's the caveat, isn't it? So far, so good for DIY fund trustees. But looking out, what do you think? Do you think it's, the three asset class strategy will continue to be a good one?
Well, look, it's hard to predict these kind of things, but you'd have to think that definitely the conventional wisdom is that these funds will start to look a little bit more like large super funds over time. Not necessarily in their size, but in their asset allocation. As the population starts to get older on average, these funds will have to think about assets that produce income, not just grow capital. And the big one there is fixed income, where Australia has a much lower exposure than countries overseas.
Yeah, and I think the other thing, isn't it, Clancy, is that retail investors, it's much easier to invest overseas now, even with ETFs, exchange-traded funds, which are listed on the Australian share market, and track indices, including overseas share markets, indices, and subsectors and so on of markets. So it is a lot easier, I suppose.
Yeah, that's right. Technology has made it easier to get a piece of these assets. And also fixed income, I mean, things like the hybrid assets at the moment that are very big, the banks are pushing further into those types of assets, so that might start to have an impact as well.
Okay, well, there's a good many things to think about there for anyone who's running their own fund. And thank you, everyone, for watching. Until the same time next week, goodbye.